Stocks our strategists feel are poised to deliver positive returns are featured now in their top stock picks of the week.
Hi, everyone. Welcome to Top Stock Picks of the Week. I'm Neena Mishra. I will share my top stock pick first, and then you will hear from my colleague, Ethan. So let me start with my top stock pick, which is Netflix, ticker symbol NFNX. And we all remember that Netflix was a member of the original FANG group, the hottest stocks in the market, and then somehow the stock lost its momentum. But lately, over the past couple of years, they have taken a number of steps, and it seems that their growth is back on track. And in fact, they have been outperforming the Max 7 stocks. So let me share my screen and talk more about Netflix. So this chart shows the competitive performance of Netflix versus the Max 7 ETF, the Roundhill Max 7 ETF Max, which equally weights all Max 7 stocks. And you will see that over the past year, Netflix is in fact up 88%, whereas the Max 7 ETF has returned 28%, and the divergence has in fact widened this year. Year to date, Netflix is up 35%, whereas the Max 7 ETF Max is down about 4%. So what is working for Netflix? So let's start with the results. They reported blockbuster first quarter results, beating street estimates on earnings and revenue. And in fact, the revenue was up 12.5% year over year, and net income rose 24%. They also beat forecasts for other core metrics, including operating margin. Now, this is the first time when Netflix did not disclose its quarterly subscriber data, and that is a part of their strategy to focus on revenue and other financial metrics as their performance indicators. So after these results, analysts have raised their estimates for the company. So if you go to the quote page on Zacks.com, you will see that analyst estimates have for the current year, next year, and the current quarter and next quarter, they continue to go up. They have gone up significantly after they reported their blockbuster results. And because of those rising earnings estimates, Netflix is now a Zacks rank number 2 buy rated stock. Now, if we look at the price consensus and EPS surprise chart, you will see that the company has been beating estimates quarter after quarter for the past 2-3 years, so which is what I mentioned there, that seem to have found their momentum back. And before that, it was like many quarters of missed estimates and all that. So again, what has been working for this company? A number of steps that they have taken, including they cut down on password sharing. They announce price hikes. And in fact, in January, they again raised their prices across the board, with the price of ad-supported tier to $7.99 per month and the premium tier to $24.99 per month. And the ad tier, which was launched in 2022, that did not see much traction initially, but now it has 94 million monthly subscribers. So all those things are working. And additionally, they not only have these very hit shows, blockbuster shows, which we all like to watch, but they have also broadened their entertainment offerings from live events to sport-related content and games, etc. And in fact, during the time of economic uncertainty, Netflix appears to have become the main source of entertainment for households, particularly when many companies are feeling the pressure from rising global tariffs. Netflix has remained largely unaffected. And as consumers are cutting back on spending for entertainment outside, they keep these streaming services like Netflix because this provides more affordable entertainment at home. So that's why investors see this stock as a safer option during uncertain economic times. In fact, during the earnings, Netflix CEO said that they haven't seen any negative impact from President Trump's tariffs so far. So Netflix was seen as kind of immune from tariffs until President Trump talked about his plans to impose 100% tariffs on movies which are imported into our country and produced abroad. But experts said that that is unlikely to happen. And the journal, Wall Street Journal, reported recently that the management aims to double revenue by 2030 and also double its market capitalization to $1 trillion. So they plan to make it a member of the $1 trillion club by 2030. Currently, the market capitalization is a little over $500 billion. Now, the stock is not cheap. As I had mentioned, it has done very well. And with its gain of over 88% over the past year, it is now trading at forward earnings multiple of over 47 times. But given all these measures and things seem to be working for Netflix, and the momentum is likely to continue, so that is why the stock is worth a look. And I will now hand it over to Ethan for sharing his top stock pick.
Thank you, Nina, and hello, everybody. I'm Ethan Feller, stock strategist here at Zacks, and today I'm going to share a stock that I am extremely bullish on. The company is called Pagaya, ticker PGY, and it's an AI-enabled fintech company, and it's got a lot of good things going for it and everything that I like to see. It's extremely cheap. It has strong earnings growth forecasts. It's got a top Zacks rank, and it's got powerful price momentum pushing the stock higher. So let me tell you all about it. Pagaya Technologies is an extremely interesting company. They got a lot going for it. It's an AI-driven fintech company. It was founded in Israel, and it specializes in credit underwriting using alternative data. So basically, instead of relying solely on traditional FICO scores, Pagaya's proprietary AI models assess borrowers' risk profiles through a broader lens, and it enables partner institutions to approve what they call second look loans that might otherwise be rejected. I'll explain a little bit more what that means. So the company operates behind the scenes. It's a business-to-business company. They work with banks, other fintech companies, and financial platforms that are looking to increase their access to credit and also manage risk. It's always important to accurately price the people you're lending money to, their risk profiles. So they work with companies that do like buy now, pay later, BNPL, and they actually just took a big step forward. So while they were normally just focused on analysis for other financial institutions, just recently they took a major step forward in operationalizing its AI. So they partnered with Klarna, a very well-known buy now, pay later company, and they issued a $300 million bond backed by BNPL loans. And it marks the company's first move into its own financing operations, and it showcases how the AI underwriting engine is being applied beyond just personal loans and into new verticals. So it's a big step for the company. The bond was arranged by JP Morgan and Apollo, and it was oversubscribed, and it included AAA rated tranches. And so there's clear proof of concept for the business. So it's not just doing AI and analysis, it's actually building a broader fintech company, or broader financial company, really. So yeah, as I said, there's so much going for the stock, and it's like my new favorite pet stock. So you can see, obviously, it's got Zacks rank 1, which is indicated by its upward trending earnings revisions. You can see it's only a $1.24 billion company, so it's pretty small. It's got a lot of room to run. You can see the two covering analysts have really made some hefty revisions higher to its earnings estimates. Current quarter earnings have jumped by 41%, earnings estimates rather. Next quarter, earnings increased by 36.6%. This year is up by 42%, and next year up by 30%. So those are really big jumps in expectations. So that's part of what's driving the stock higher. And something really notable is it's kind of like my favorite way to find a stock. I found a couple like this where the company was unprofitable for a long time. So you can see in this price chart, it had an IPO in 2021, and that's when everything was really hot and it had a big run up. I mean, it got to $300, which is pretty incredible, and then it crashed massively. And it's one of these high growth companies that was unprofitable, and that for me, it's difficult really to invest in a company that isn't actually net profitable. They're just pouring money into advertising and operation, hiring, and is there a real business model underneath? And it can be hard to tell. But in the most recent quarter, earnings inflected meaningfully higher, and they're now earnings are positive in a big way. You can see this year's earnings are expected to be $2.45 per share, which means the company has a forward earnings multiple of just 6.7 times, which is really cheap. And you can see earnings are expected to grow 28% next year. So you get really good growth, and it is really cheap. And you can see just in this last quarterly earnings report, Q3. I'm sorry, the March report. This Q3 earnings were expected to come in at 10 cents. Oh, sorry. I'm going to show this in the chart. But let's take a look at the sales and earnings growth. Sales this year are expected to jump 20%. Next year, 15.7%. You see earnings, huge jump in earnings. Last year's earnings were just 83 cents, and now they're $2.45. So really big things for the company. And this was the earnings I wanted to show. So earnings were expected. So this was a March 25th. This is what I'm earnings were expected to come in at negative 14 cents, and they had a huge surprise to the upside, positive 24 cents, and there were a little upside surprise in sales growth as well. So, we can see that the stock has really made a big run since its lows in April. It's $9 back in April, and now it's $16.30. It got put on the Zacks rank, I believe it was this day, either May 7th or May 8th, and it's really started to really run since then. I highlighted it in this little flag a couple of weeks ago. I've really been keeping my eye on it. So we can see that it broke out from this technical pattern, broke higher, and it's pulling back. And I think this is actually a really good buy area. You can see it filled that gap, which is a common technical move. And, I wouldn't be surprised if this low this morning was below for a long time, and this thing just rockets higher again. Because again, it's so cheap, and it's got a real thematic tailwind. I mean, it's AI enabled, and it's not just like fake AI either. Like, they really do use AI in a practical way. So I think, you're going to see a lot of institutional investors really pile into this thing, and it's cheap, and it's really making a lot of money now. So if you look a little farther back, as I said, stock crashed from here. And it's sort of just traded sideways for a long time. So this kind of descending level of resistance is really important. And I think, we break out here, maybe we test this level and then break out higher again. But I think there's little reason for this to go higher. Like I said a million times, considering it's really cheap. And that's Pagaya. That's all for today. Thank you everyone for tuning in. I hope you enjoyed this. If you want more from Zacks, go to zacks.com/promo and subscribe. Thanks.